So we'll get started. Here's our agenda for today. A little bit on some of the macro signals, primarily focused around the fixed income markets, because those are really what's driving a lot of activity right now. We do have some updated portfolio themes and asset class rankings that we updated here in Q4. And then just some notes from our meetings, both in Atlanta and Palm Beach. Just a quick note here on the overall state of the U.S. economy. Certainly, this is a key reason as to what markets are doing on the fixed income side. And I think really that's these decelerations that you see here more recently. This is a picture of the services and manufacturing sector of the economy, basically over the last 12 months. Any reading above 50, which is basically right in here, indicates expansion in that sector. Any reading below 50 indicates contraction. So just as you might notice, for the last year, the manufacturing sector has been in contraction pretty steadily. Services sector has bumped around positive territory for quite some time as well. And this has really opened up a little bit of a dichotomy into what's working in the economy and what's not. And certainly that's starting to reflect in some of the stock prices of those different types of companies. But more recently, what you notice is starting in September and then through October into November, both the services sector and manufacturing sector have been in a pretty steady decline, nothing precipitous, but in a decline nonetheless. Point to point, for manufacturing, point to point for services. And this is giving a bit of a deceleration effect on the economy, which is also allowing interest rates to maybe move a little bit lower than where they might normally be with the inflation that's in front of us. So this is actually a positive scenario because it does feed into the Fed's transitory narrative of inflation. And certainly while inflation has been rising the last 3 months, 3 months in a row, actually, these types of readings do suggest that we should be potentially topping off here, although we don't want to be too complacent about inflation. But this is allowing interest rates to come off their highs here a little bit more recently. As far as the yield curve itself, I just wanted to show you, kind of how we've evolved here since January, and really some of the bigger moves that have occurred over the course of the year. And so what you'll notice here is still, after having a big drawdown in the Silicon Valley timeframe of March, April, rates have steadily migrated back higher. And then this little squiggle here at the very end of the chart, this was the last 5 trading days, actually, the last week and a half. They took a pretty steep dip lower, and this was on account of the fact that the U.S. Treasury issued their guidance to say how much they would need to be borrowing over the next 16 weeks. And it was lower than the expectation. Combine that with a deceleration in the economy. This is why rates have come down, and was entirely fueling the upside in markets that we saw last week. I think small cap was up 7%, S&P was up 5%, and what that just shows you or tells you potentially is that there was a lot of short interest in the market going into the Fed meeting, which occurred last week as well. And the fact that the Fed did not raise interest rates, they stayed pat for the second meeting in a row, has a lot of investors feeling that the highs may be in for the Fed funds rate. We're not necessarily so convinced of that. You still have to keep an open mind to possibilities, but certainly the probabilities now suggest the Fed is going to be on hold for a little bit of time, and that's giving fixed income investors a bit more reason to be positive. And we'll talk about our positioning as well too. The second item of the yield curve we wanted to talk about is the difference in the 10-year versus the 2-year bond. Reason we like to show this is because generally when the difference in 10-year and 2-year goes negative, as it did ever so briefly in 2019, and has been very negative starting in 2022, is that if you go back to 1980, every recession since 1980, recessions have been preceded by not necessarily going negative in this number, meaning the 10-year versus 2-year is a negative territory, but it's actually this what they call steepening, which means that the 10-year bond yield versus the 2-year gets back towards a more historical relationship of 10-year being higher than the 2-year. And that's generally been a pretty reliable signal that recession is on the horizon now. Not necessarily warning lights going off, but more it's more only a matter of time type of situation. So that would put recessionary time frame still a little bit ways out, but somewhere in that between first and third quarter of next year. And so we have to be mindful about maybe how much of that is already priced into certain parts of the market, but also what might not be priced in. So again, more thoughts on that here in just a little bit. Turning to some of our themes here, we've definitely updated this to reflect some of the more recent market dynamics that are in front of us. And certainly want to recognize, number one, here in the upper left-hand corner, that there's been a lot of pain already taken in the bond market. So certainly in our conversations with clients and in discussions we've had with various other asset managers and market participants, there does seem to be this kind of sigh of relief now that the Fed's on hold now, and that we can all get back to thinking that bonds are not going to be at risk anymore. But we have to be, I think one of the things we wanted to point out here is that this type of bond market pain does have a tendency to metastasize into other areas of the markets, not just fixed income, but primarily I'm thinking things like commercial real estate or the banking sector in particular may have other losses that need to be dealt with. And so this is why we're not necessarily thinking that we're going to be entering a new bull market phase, because there's some additional issues that need to be worked through. Not that the market's going to collapse per se, but there's some additional issues that are likely to pop up over the next 6 months that will need to be dealt with. Certainly, despite today's action within energy markets, we still think commodity markets have been an interesting place to be for sure. In our strategies, we've had a bit of an overweight to the energy and metals and mining sector within our equity strategies. That's worked out quite well. But we still think this is an area of supply issue that across a number of key commodities that are likely to be in more demand, as certainly we look to things like electrification of the grid, electric car vehicle adoption, things of that nature are only going to require more and more intense commodity usage. And this is something that underinvestment in supply has gone on for the better part of a decade. And now I think we're going to be paying some of that back here with higher prices for commodities. And then the last one I just wanted to highlight here, this one on the lower left has been pretty consistent, but this one on the lower right, the Fed being on hold, I just want to point out, it does not mean we're in the all clear. As I mentioned, we still have some issues to deal with, whether it's in commercial real estate or banking sector. And that's likely to pop up when you least expect it. And it's been very difficult to forecast those types of events. So we still want to take a little bit of a cautious approach, not to say that we're underweight equities at all. So a 60-40 portfolio still has 60% allocated to equities. But we certainly want to make sure that we are dealing with risk management within that sector or in other ways whenever possible. We can talk about what that means here at the end, but certainly until the inflation genie has been put back in the bottle, which is very difficult to do once it's out, that tends to have a way of coming back. And we're still hoping that the second wave of inflation doesn't go a lot higher from here, but we'll just have to wait and see what the data tells us. Investment rating wise, I think we showed this last time, but these are just two changes that we have been looking at from Q3 into Q4. One is downgrading small cap back to a neutral weighting from an attractive weighting, given that now the recession is probably more in front of us or closer than maybe it was over the last 6 months or 9 months. Still have a neutral weighting for large caps, so we're not going underweight to that sector. Mid cap has held up relatively well relative to small cap, and still is at a discount, trading at a discount to large cap, which is historically very unusual. Usually mid cap and small cap tend to trade at small premiums to the larger cohorts, and that's not the case right now. So we think there could be some opportunity there, particularly if rates stay higher for longer. Still have no real exposure to emerging markets, a small exposure to developed markets. which, talking about this with clients in our Atlanta and Palm Beach events, one of the areas that we'll talk about, well, actually, that's in that section. We'll cover that here in just a minute. So I'll come back to that. On the bond side, this is, I think, the area that we've probably made some adjustment in thinking to. Still really want no exposure to emerging markets right now, especially when emerging markets are trading at yields that are almost identical to high yield in the US. So no real reason to step out into that, in my opinion. Downgrading higher quality corporates just because, if you can achieve similar corporate yields in government or agency bonds, why even bother, particularly as we approach recessionary conditions. And then municipal bonds, we've upgraded, I think, that in Q3, just on the back of the idea that muni yields on a tax equivalent basis now are much more attractive than they were starting the year. And so adding those back at tax equivalent yields of 6+% for short to intermediate term munis makes a lot of sense, I think, for some portfolios that need fixed income. And then I think in this environment as well, this is just a good setup for alternative strategies, particularly things like real assets, but also things like liquid alternatives or private alternatives still have, I think, ample upside in front of them, particularly when you think about strategies that do well with higher levels of volatility. So think trading strategies or macro strategies, those all stand to do pretty well. And even private lending strategies right now are very attractive. Just moving to some of the meat of the investment outlook here, it is important to recognize that we are in rarefied air with the technology sector relative to the S&P itself. So what you're seeing on the screen is the price performance of the technology sector going back to, believe it or not, 1926, over the last 100 years, actually. So this is like the Nifty 50 era. This is the dot-com era. And now here we are in the 2010s era, post-financial crisis, where performance in the technology sector is trading at now almost 2 standard deviations relative to the S&P itself. And that just draws your attention, of course, that there is ample evidence to suggest that technology now as a cohort or as a sector is in much better health than it was at either of these 2 points in time. Just examples to me that come to mind are, most of the Magnificent Seven, as they're called, are very profitable companies now, versus in 2000, a majority of the NASDAQ was unprofitable. I'd have to check my data on the companies in the Nifty 50 era, but I would venture a guess to say it was probably very similar. All that to say, we're not wholesale sellers of technology at this point, but what we are doing is taking some profit on names that I think I've conveyed over a number of the past months. That just makes a lot of sense to do right now because we are trading at valuation levels that are in some rarefied air. And, I think some of the harsh medicine is now starting to be taken. And I thought this was really well-timed, this announcement, which is this morning, WeWork, which used to be, by the way, a $47 billion valued company when it was private, is now worth, a couple of $100 million after. So you can see the price performance since it IPO'd. It doesn't actually show you the previous valuation history of the shares, but it was much, much higher because SoftBank and the Vision Fund were large investors just continuing to put capital in. And, again, this is I think a healthy dynamic within the market because it does suggest that there is some self-correction going on here within the technology sector. So, technology isn't necessarily a monolith, I would say here, and that the fact that we are starting to see these types of bankruptcies and substantial drawdowns in speculative areas is a really healthy dynamic. So WeWork here is in the purple line and the S&P is in the orange line since IPO. So in other words, this rationalization in technology is starting to occur, which, I think makes that sector a little less aggressive than it might seem. One thing that we're still just trying to parse through, I think I was mentioning earlier, relating to small cap versus large cap, and this may just be something that underneath the surface is the structure of the small cap market may be changing. And we're doing a little bit of research on this to try to get to the bottom of this question. But historically, when you've gotten expansionary periods for the economy, like you had coming out of the dot-com crisis or bubble, coming out of the 89-90 recession, small cap would generally be leading the market higher, leading the S&P higher. Because if growth is widely distributed across the economy, smaller companies are more sensitive to changes in growth and therefore have a disproportionate upside when growth kicks back in. But what you can see here is that really starting in the post-financial crisis, 2008-9, small caps did lead the way market higher for a few years, but have just actually over the last, call it 10 to 12 years, significantly underperformed the S&P, primarily because I think of the structure of the underlying market. Private equity has certainly had a big role in that as well too, where I think Blackstone is larger than ever in taking private small cap companies. But there's also, maybe benefits of scale on the large cap tech side that aren't available to small cap companies. So what we would really like to see, however, is that broader small cap participation to get much more excited. It looked like we were going to see that out of COVID, but that's really reversed quite dramatically. So it's an area we're keeping a close eye on. Just a quick earnings update. Now, I do give these every now and then in the 2 minutes segment that we publish on Monday, but I did think these numbers have changed pretty substantially over the last few weeks to warrant sharing again. And this is just a year-on-year look at Q3 earnings, because earnings are the driver of market returns, despite what a lot of people might want them to be. And what you can see here is based on the expectation of negative earnings in Q3 coming in on September 30th, what's actually happened is S&P 500 companies year over year have grown earnings 3.7%. So this swing from a negative expectation to a positive swing, I think accounts for a lot of the reason why, despite the fact that rates are where they are, the S&P has been able to hang in there at around these 4,500 level pretty comfortably. And if companies can continue to surprise to the upside, particularly in the heavier weighted areas like information technology or financials, consumer discretionary, then we're likely going to be kind of in this churning phase as opposed to maybe a wider drawdown for the foreseeable future. On the bond side, just wanted to share again kind of this picture. This is a year-to-date picture now of just the 10-year itself. And you can see we've been on a pretty wild ride for the whole year. This is really important to just understand, because these changes are generally used to occur over multiple years and historical periods of time, I think 80s or 90s. Whereas this year we've gone from a low of 3.3 in April to a high of 5%, and now we're at 4.57 roughly. This was as of yesterday. And this type of rate volatility, I think I just wanted to point out, this type of up and down is really emblematic of the fact that, or I think showcases the fact that investors still are on very tense footing relating to where they think rates are going to go. So the fact that rates came so far down so quickly last week just tells you there was a lot of short covering going on. A lot of leveraged investors were exiting their bets. And that's why we really have to gauge where rates are going to go over the next probably 2 to 3 weeks as some of that positioning with hedge funds starts to exit the market. But I think this has been a useful picture for us to also demonstrate why we've been in a very short duration portfolio in fixed income. So think about duration is another word for interest rate sensitivity. And so our portfolios were not very impacted as many others might have been when rates were rising. And of course, it cuts both ways. As rates are falling, we're not benefiting from price appreciation necessarily. But this is an agenda item that we've been discussing pretty actively as an investment team and as an investment committee is, okay, when should we start adding back to duration? And we're likely going to start very incrementally adding back to some of our interest rate exposure versus where we are right now, which is where we have very little. Part of the reason that we think now could be a decent time to start adding back to some interest rate exposure. Again, not a 30-year bond, but maybe going from 2-year duration that we're at right now to maybe a 3-year or a 4-year duration, is something that we want to obviously keep top of mind, because now bonds are giving us an interesting starting point from a interest income standpoint or a coupon standpoint, and that should provide some ballast to returns for the foreseeable future. Combined with that, with the fact that this is again the 20-year bond return that we showed everyone last week or last month, actually being down 42%, actually provides a pretty useful starting point now that we've seen likely most of the negative drawdown in long bonds. From here, we're not 100% certain with that, which is why we're not going to go into long-term exposure. But this type of drawdown, I think, definitely gets us much closer to an attractive entry point to extend duration. And we feel pretty comfortable that, the worst may be behind us from that standpoint. One thing I also wanted to share too, this is something we haven't really touched on before, but this chart does do a pretty good job of underscoring when we're in a risky condition for bonds and when we're in a less risky condition for bonds. And so I've tried to highlight those areas of this chart in red and green, red being risky, green being attractive. And you can see here on the bottom what the x-axis is, and that's the average 3-year core inflation. So right now, average 3-year core inflation is probably somewhere in between 3 and 4, but it's coming back to this greener section. And then this on the y-axis is the stock bond correlation. And the reason this is important is because if we have a big drop in stocks, we want our bonds to be there to protect the portfolio in a non-correlated way. That's the only way you can have that protection. Because if bond prices were dropping at the same time stocks were dropping, that would be a positive correlation, and we would have no benefits to owning the bonds. Whereas if we can find some way to get back into between the 2 to 3 range, you can see here the plots get much more in our favor. So this is why we feel that if inflation does trend lower from here, which it's certainly possible, we'll be watching the data points as they come out, that adding duration to bonds is only going to work in our benefit from a diversification standpoint. And so here are just a few of the key takeaways that I just wanted to highlight, and then we'll touch on some of our notes, questions that clients were asking during the presentations. Stocks have had a great rally so far in 23, defying a lot of the expectations of ours as well. I think we came into the year thinking low to single-digit returns on equities were in the forecast. Currently, where we are today, S&P is up around 13, so certainly we were not accurate on that forecast. But from here, it certainly is worth understanding that trading at a valuation that's relatively elevated at 19 times earnings in the S&P, and when the 10-year Treasury is at 4.7, there is some competition for capital. This is one reason why we think even though earnings are growing, stocks are likely to be violently nowhere. So a lot of action up and down, but probably not going much of anywhere. Now is again a great time to be managing risk because of where stocks have traded to, and the market is giving us a great opportunity to either rebalance accounts, do some tax loss harvesting, or trimming back positions. And just one thing of note for anyone that's not a Gratus client, be mindful of capital gain distributions coming out of mutual funds, because again, this type of year where there have been a lot of flows generate a lot of capital gains distributions, and mutual funds specifically, which is why we've actually exited most, if not all, of our active equity mutual funds in favor of either index ETFs or active ETFs, or we own the companies outright. We still prefer active strategies over bonds. We didn't quite achieve the level of interest rates that we were hoping to achieve to maybe knock down our alternative exposure in favor of bonds. but nonetheless, we still prefer a little bit overweighted position to alternatives versus bonds. And it's important to know we're still in a rising inflationary environment, even though it's come down. Last 3 months, inflation has been trending higher, so those would tend to be conditions where alternative strategies work well, but we'll just have to be mindful and adjust accordingly. And then just also to point out, there is some reinvestment risk now so stepping out a little bit in duration is something that, again, we're looking to potentially do in the face of both a recession, but also a decline in rates from here potentially. So nothing too aggressive, but we just want to be mindful that this is likely something that we're going to be doing in the future. So just a couple of notes. So again, thank you to everybody that joined our live events, both in Atlanta and Palm Beach. And here are just some of the few of the notes I took away as key questions clients were asking. One is, and this is kind of an evergreen question that we get from time to time during these meetings, but I think I heard it twice, so hearing a question twice is enough for me to think it's probably on the minds of a number of people. That is, we've got an election coming up, but when will budget deficits and the debt start to matter to the stock market? And I think not to be, too short-sighted on this or to be glib about it, but I think the answer is not immediately. So and the reason I say this is because there's some lessons we can learn from Japan, because Japan really is the case study of a developed market country that has a very systematically important currency. And they basically took their GDP, debt to GDP level, meaning how much debt do they have relative to the size of their economy, from levels where basically the US is trading right now, so a little over 100% of debt to GDP, to upwards of 250%. And what's happened during that time is that interest rates have gone down, actually down, believe it or not, in Japan. A lot of that's because they self-fund, but also the growth rate in Japan has come down as well too. So I think that's a likely outcome here is that the larger our debt burden gets, the lower our future growth potential gets, barring some massive breakthrough that's going to substantially change productivity or step changes in energy consumption. And this is something that we just have to be aware of because there are examples of how debt burdens have impacted economies. One area that we are looking at, which I think is also a signal from Japan, is to say one reason that you would know there would be problems on the horizon with the massive debt and deficits that we're running here in the US is if the US dollar currency relative to our largest trading partners started to decline pretty rapidly. Now, it did start to do that at the end of last year. I think it went from dollar index went from 110 down to 100 very rapidly, but it really held there. Now it's gone the other direction. But particularly when priced in terms of maybe gold or the euro or the yen, that would, I think, really be something to watch and be a key signal to let us know that we're experiencing problems within our currency and the debt and deficit in particular. Another great question a couple of clients asked, both in Atlanta and Palm Beach, is artificial intelligence just another fad that will fade away over time? I think it's easy to think that this is possible because there are some examples from history that would suggest some of these new crazes are likely to flame out. What's different about AI, though, is that this is maybe something that's still very much in its infancy, number one. Yes, there's a lot of money going into it, but it's coming from strategic partners primarily. So think OpenAI, they're the ones that are behind ChatGPT. That's being backed by Microsoft. Microsoft made a very substantial investment in OpenAI. So the companies that are backing these AI innovators or new AI companies are all, in a lot of ways, profitable companies. So there's not a lot of risk to them going away necessarily. I think what I heard from our guests that joined us talking about this exact question is that it's likely to be like these AI chatbots or programs are likely to be more like co-pilots, making existing workers much more productive, as opposed to outright replacing, whole cohorts of the workforce. So I thought that was a really great way to think about it, because these are going to be systems that will be enhancing to all of us that are currently still in the workforce. And thinking about ways we can utilize that more effectively is certainly on our company's mind, but also a lot of other companies that we interact with. And then the other one, which is really, really hard to do, is AI going to be better than advisors? Said maybe a little bit tongue-in-cheek, Stuart. Thank you for that. So it's hard to tell, because we have had some experimentation already in the marketplace with what they call robo-advisors. So if you think about Personal Capital or United Capital or some of these other ones that tried to put in place automated investing programs that would do a lot of the investment work and things of that nature automatically. I think there is some application or some scope for a lot of these tools. So we certainly use, a lot of AI-driven data analytics tools for our own purposes, for analysis purposes. But I think it'd be a big stretch to think that an AI would replace advisors entirely, because there's just a lot of nuances to personal financial planning, number one. Number two is with a lot of the way that which rules and regulations are changing so quickly, there would need to be some concept of how to handle enforce changes, but also on the investing side more specifically, and maybe to what we do at my group. I think it's really difficult to think AIs are going to be able to replace some element of human discretion. Certainly some of it, no question. But replacing humans entirely would lead to, I think, really, really volatile markets, because if you think about what an AI does, they're using historical patterns and data to determine where they should be allocating capital, and not using much by way of a predictive aspect, using other things that may be a little less tangible, like management teams, things of that nature. And I think in that way, the old saying, of course, is past performance does not indicate future returns. And I think that's exactly what the application of AI does today. Maybe in the future, there'll be more inference baked into those systems, but that's kind of my thoughts on that. So the other would be going back to this question about the 2024 elections. So I think these were, again, two questions we heard both in Atlanta and Palm Beach. A lot of interest in this, of course, because you have candidates that maybe on both sides are suboptimal potentially, or the leading candidates. But still too early to tell. And until the field narrows a bit, we definitely want to reserve judgment. Particularly when you look at the Republican side, I think it's still fairly wide open. So we'll reserve judgment there. But just as a reminder, markets tend to trade, a little bit weak into election periods, but then for whatever reason, as uncertainty is lifted, but I think it's primarily because of the uncertainty related to, what potential tax policy changes could be and things of that nature. After election results are known, that's when markets tend to have what they call relief rallies, because now investors can base decisions on what's likely to happen versus a very wide range of outcomes if it's either a Democrat or Republican. So thank you for that. And I think that's all we had for today. Thank you for joining us today. We look forward to speaking to you again sometime soon, and take care.